what's in store for rest of the earnings season. Let's discuss that with Anish Damania. He's head of institutional equity with Emkay Global Financial Services. Anish, good morning. Thank you for joining us. Anish, if I map market internals, surely bulls have taken some kind of a back seat. Do you think this is beginning of some kind of a downtrend or a overall or a blip in overall rally?
I think the way I would put it is that if you look at the last 6 months, the entire rally has been driven mainly by inflows, except for 1 month of October numbers where we saw very strong IIP growth. All macroeconomic data has been deteriorating. So, and even now November is back to a very small zero to minus sort of a decline in IIP. So when I look at the earnings numbers, when I look at the macro numbers, they are not that positive. However, what is positive is the flow. The flow is still continuing, and till the time this flow continues, this kind of a movement in the market just can be termed as a correction and a breather to the market at this point of time.
Anish, I'm warning in December, if I'm not mistaken, you had removed INFI from your conviction buy list after the performance that we've seen this quarter. How would you approach INFI now?
Okay, the way I would look at it is that the expectations were sort of toned down to say that things are not as bright and things are not as great as what most people think, and therefore probably what you saw is that a lot of analysts brought down their expectations and they couldn't see any green shoots in the technology sector. So given that fact, I think what happened is most analysts, including ourselves, thought it prudent to now disconnect our conviction buy list to a lower degree out there. The results which came out were a lot higher than expectations, and hence we saw this huge upsurge. But our argument is that if you look at the numbers per se, they were better than expectations, but under no way they show that things are now brightening up there if you see all the numbers which had come about.
So, Anish, after Friday's 17% appreciation, Infosys now based on FY 14 estimates is trading at about 10-11 times. Average P for the Indian IT industry is about 14 to 15 times. So would you still say that after Friday's run-up, Infosys is still looking cheap?
See, the way I would put it is that if you look at the last 6 quarters, the stock has been seesawing by 8 to 10% after every quarter. This does not give me a lot of comfort to say that, okay, the next quarter will be a stable quarter in terms of how the stock price movement will be given the expectations versus the deliverables. So one is not very sure about what kind of deliverables could come about in the next quarter. Knowing that there could be surprises either on the negative side or the positive side. So if you really look at it, Infosys has derated in a way, and I think that derating is not going to improve substantially unless and until we see a couple of quarters of kind of stable guidance or company meeting its own guidance in the way in which it gives.
What's your expectation then, Anish, from TCS today?
I think TCS we are looking at kind of 3% quarter-on-quarter growth. So TCS numbers may not be, we feel that may not be far different from what most market expectations are.
If TCS numbers are in line with estimates, could that be more like a sell-on news event?
I don't think so, because if I were to look at TCS has been a more stable stock in a way. And if I were to weight myself now more in IT, given that there is an expectation that, okay, things can brighten up going ahead, then I would rather remain in TCS at this point of time. So I wouldn't say sell on this rise or something. I would say you hold on to your position.
So given the kind of global backdrop we are in, Anish, what to your mind could really precipitate a correction? And to your mind, what could be the quantum of correction whenever correction kicks in?
The only thing which has led to this rise in the stocks has been the FII flows. If you look at it domestic, there have been sellers and they continue to remain sellers across the board, be it insurance or be it mutual funds, or as I see on our retail front, even retail is extremely light on positions. So to that extent, if the FII flows were to dry down to a trickle, then that could cause a correction, and I won't be surprised if that happens, and you could see about a 10 to 15% correction in the markets.
Anish, as a house, you've been bullish on Bajaj Auto, and my compliments. That call really has worked very well for your firm. But at the current juncture, do you think Bajaj Auto is priced to perfection? Because based on your estimates, I was reading your firm's report in the morning, Bajaj Auto is now trading at something like 17, 18 times, on FI14 estimates.
That's true. If you look at our recent note, once again, what we are now saying is that Bajaj Auto has done its bit, and it's now time for Hero Honda to take up that mantle and move ahead. So we are now focusing on the fact that we would see a better performance come about in Hero Honda. Also, we have sort of downgraded Maruti to a hold. We feel that most of the upsides are now captured into the stock price, and we continue to remain buyers of Mahindra and Mahindra, and on the mid-cap side, Exide Industries.
Anish, cement has been seeing a sell-off of late after the good performance that we saw all of last year. How are you approaching the biggies like ACC and Ambuja in this space, and is there any mid-cap that you would now bet on?
See, in the cement stocks, I was just doing some work, and I found that the cement story started about 9 quarters ago, when the stocks had kind of bottomed out, and we saw about 80-90% run in almost all the cement stocks, and that coincided with 7 quarters of continuous high double-digit growth coming from quarter 4 FY11. So that continued right till quarter 2. So in quarter 2 we saw a growth of about 94% in PAT and 52% in EBITDA. However, when I come to this quarter now, it's quite an unusual quarter, given that third quarter usually should be better than the second quarter. We are seeing lower price realization on our basket. We are seeing a little increase in costs, and therefore EBITDA margins will slip from about 1,040-50, which they did last quarter, to about 870 in this quarter. So on a YOY basis, we are seeing about 1 or 2% increase in EBITDA and about 3% increase in PAT, coming down from the 94% or the very high numbers which we had seen over last 7 quarters. And I'm not so sure whether the fourth quarter will pan itself out to show better numbers. So we did some analysis. We took a 2% price increase, we took a 2% cost decline, and we took a 15% quarter-on-quarter volume growth, which is the highest on a third quarter to fourth quarter basis. And we worked out, it still works out to kind of flattish numbers on a YOY basis. So if we are going to see at least 2 quarters of pain, then the current valuations don't sort of take that into account, and I think the stocks will correct some degree, another 5 to 10% from these levels, if that is the case. On the mid-cap side, obviously things could be a little different, so we continue to prefer Madras Cement and Shree Cement in the pack, and those are the stocks which we feel will probably outperform the larger caps.
Anish, what is the deal with Suzlon? In quick time, Suzlon has appreciated from levels of 13 to about 20. Now it's official that Suzlon has already applied for CDR, which is credit debt restructuring. Last year when Wokhard had applied for a CDR or a credit debt restructuring, that stock got re-rated after that.
Very difficult for me to comment on Suzlon. We don't cover that stock. The only thing which I would like to say when you compare Wokhard and Suzlon are two things. One thing, if you look at Wokhard, the business continues to be strong, and I don't know about how Suzlon will be carrying its business forward in terms of how things would be there, because that is one stock which we don't cover. So if the business becomes stronger, then you will have a Wokhard-like situation.
Anish, what's your take on the consumption names, the likes of an ITC, Unilever? Is the peak over for these stocks, or do you think there's still, it still makes sense to actually hold investments in these names?
We are negative on Hindustan Lever. We feel that in the last quarter there was a shock on the volume. Our analyst believes that this quarter there will be a shock on margins in case of Hindustan Lever. Should that come about, then the stock will continue to underperform like the way in which we have seen over the last 3 months it did. So Hindustan Lever is one such name where we feel that things are not yet at the current valuations. Things are not yet bottomed out for them as far as the stock underperformance goes.
So if you are bearish on HUL, why are you bullish on Colgate? Colgate arguably is indeed one of the most expensive stocks, on BSE or NSE.
The volume traction is better, the margin traction is better, and that is where we feel that Colgate will have a better performance than Hindustan Lever. And I think if you see, the performance has also borne itself out.
What about mid-cap real estate then, Anish? A whole host of these names are doing pretty well in the last couple of trading sessions. Anything where you see value?
I think we had recently gone to visit DLF, and DLF once again reiterated that they have a huge plethora of projects coming up, and these projects are getting sold. So to that extent, I think real estate is back in action, and if the top names come back in action, probably action will also shift to the mid-cap names as well. I don't often recall of a mid-cap name which we are pushing, but as we are sort of aggressively pushing DLF as a big name.
What are the sound bites you are picking up from some of your institutional clients? Are you getting a sense that they want to buy, and they want to buy aggressively into this market on every decline?
If I look at the domestic clients, I think what they have suggested to me that they would like to remain 100% invested and churn their portfolio, move away from stocks which have done well and move to stocks which have underperformed with little bit of earnings growth scenario. Like for example, in the last 1 month, we have seen people move away from the little bit of cement names and gone into energy utilities, which is oil and gas as a space. They feel that with the government doing what it is, these stocks can re-rate back up to levels which they were trading about a year and a half ago. So that could give them about a 15-20% run. And as a result, we are continuously seeing this kind of scenarios pan themselves out as we go by, as far as domestic investors are concerned. Foreign institutional investors, the few whom we speak to are sort of not that bullish on the market at this point of time, and were suggesting taking money off the table at this point of time. But as I mentioned, I mean, we largely cater to guys who are more India-centric, and therefore not the right guys to sort of talk to for what is the sentiment in the FII space, as most of the money which has come through allocations or through ETFs.
Anish, just looking at your mid-cap recommendations, and you like CRISIL, why is that? The stock has not done anything in the last 3 months. Do the earnings convince you, and what are your projections on the same?
I don't often remember my earnings on CRISIL, but we feel that they can deliver about 16 to 18% growth on an annual basis for the next 3 years, and this is one solid business which we feel should attract attention of investors on every decline. And what we have seen in the last 3 years, ever since 2008, that quality companies have done well on a year or a block of year or a block of 2 years. So a quarter of underperformance for a company like CRISIL only could be an opportunity to buy, as we feel that the business should deliver these kind of returns.
Anish, when we started the year, markets were not pricing in any strong oil sector reforms. As of now, we've only heard noise. There is no firm move on how Government of India will fix the subsidy problem. If in next 2 weeks, if we don't get a concrete move on oil price hike, do you think that will disturb the markets?
I think it is not as short a period as 2 weeks. Probably market will give them some more time, given that flows are dominating the current state of the market. So I would say if in the next 1 to 2 months, if nothing happens, then probably we should start seeing the wearing off of the impact of the announcements which they have done on the oil space.